Have you ever wondered how certain states just seem to possess like a structural cheat code for their budgets?
Oh yeah, like they have a magical money tree hidden somewhere.
Right. Exactly. I mean, think about how state governments normally get their money. They tax your personal income or they tax the groceries you buy or, the physical property you own.
Yeah, the usual suspects.
But Delaware, they found a totally different path. They found this golden branch that just drops fruit year after year. It lets them fund roads and schools without heavily burdening their own actual residents.
Because they effectively monetized corporate law. I mean, they made the legal foundation of American business their chief export.
And it is a massive export. For Delaware, that money tree has always been its status as the incorporation capital of America. Millions of businesses, I mean, from your favorite local startup all the way up to the biggest Fortune 500 giants, they are legally registered there.
Yeah, it's just the default setting for business.
It really is. But we're looking at some new data today, and it suggests the leaves on that golden branch are, well, they're starting to brown.
And that is the kind of underlying structural revenue shift that just keeps state budget directors staring at the ceiling at 3 in the morning. When your primary economic engine starts making a funny noise, you have to pull a car over and look under the hood.
You absolutely do. And that is exactly what our mission is for today's deep dive. We are digging into a deeply fascinating and honestly rather alarming new report detailing a major financial shift in Delaware's business model.
Right. It's a July 2026 report called Delaware's Corporate Franchise Revenue No Longer Plugs the Gap.
Authored by Charlie Copeland. And before we really get into the numbers, Copeland's background actually matters a lot here, doesn't it?
It definitely does. He's looking at this not just as like an economist crunching spreadsheets for the Caesar Rodney Institute, which is a public policy think tank, by the way, but he brings a very specific insider perspective.
Because he was actually in the room for these kinds of things.
Exactly. I mean, he has an MBA and a BS from Duke, sure, but more importantly, he's a former Delaware state senator. He actually served as the Senate minority leader.
Wow, okay.
Yeah, so he knows exactly the kind of conversations that happen in those closed-door finance committees when revenue projections come up short. He has seen the frantic search for couch cushion money firsthand.
Now, real quick, because we are diving into state budgets, legislative choices, and tax philosophy today, which, inherently brushes up against politics, we want to be super clear. We are strictly playing the role of analysts here.
Right. Exactly. We are not picking sides.
We aren't endorsing Copeland's views or the Caesar Rodney Institute or the lawmakers on the other side of this debate. Our goal is just to look at the raw data and the arguments presented in this source material impartially so you can see how the financial gears are actually turning.
Absolutely. We just want to map out the machinery for you impartially.
Okay, let's unpack this. Delaware has relied on the corporate franchise as its primary fiscal engine for decades. And when we say corporate franchise tax, we aren't talking about like a tax on a fast food franchise.
Right. No, not at all.
In this context, the franchise is the literal right to exist as a legal entity in Delaware. It's the fee you pay for the privilege of being a Delaware corporation.
And those registration fees, they float roughly 30% of the state's entire general fund.
30%. That is huge.
It is. It has been the state's completely dependable workhorse for a long time. But according to Copeland's report, that engine hasn't just slowed down, it has totally stalled.
And the data he uses to prove this, it comes directly from the state's own internal metrics, right?
Yeah, he points to the Delaware Economic and Financial Advisory Council, DEFAC.
Right.
And DEFAC isn't some partisan group. It's the official, nonpartisan revenue forecasting body for the state. They set the hard numbers that the legislature actually has to base their budget on.
So what are the numbers saying?
Well, if you look at their recent forecasts, the corporate franchise tax slipped from just under $1.40 billion in 2023 down to roughly $1.32 billion in 2024.
Wait, that is an $80 million drop on your single biggest revenue line?
Yeah, it's a significant hit,
Right.
but the projection going forward is what's really catching everyone's attention. DEFAC expects that number to remain basically flat at around $1.34 billion every single year, all the way through 2028.
Flat for 4 years.
Right. And Copeland points out a vital economic reality here. A flat line sounds stable, but you have to look at it in chained dollars.
Meaning you have to adjust for inflation to see the actual purchasing power.
Exactly. If your revenue stays flat at $1.34 billion for 5 years, but I mean, the cost of the asphalt needed to pave Interstate 95 goes up, and the cost of healthcare for state employees goes up. That flat line is actually a massive structural deficit.
Losing ground without realizing it.
The state is effectively bleeding purchasing power.
Hmm.
In real terms, after inflation, that flat line represents a decline of close to 10%.
10% less purchasing power for the state government to actually buy things and fund services. That's rough. Now, reading through the report, it hit me that this isn't just a simple story of a state losing revenue. It's this weird paradox of losing revenue while simultaneously gaining customers.
Yes, that is the real anomaly here. The Delaware Division of Corporations, they show a 25.4% increase in total business entities since 2021.
So they grew their customer base by a quarter, but the revenue is down 6% in real terms.
Right, because the revenue per business entity dropped from a peak of $904 in 2023 down to about $807 today.
Okay, my mind immediately goes to a legacy country club analogy.
Oh, I like that. How so?
Imagine a historic, super prestigious country club that is just bragging to its board about having record membership applications. People are flooding through the front gates. But when you look at the actual ledger, the club is making less money overall.
Because the overhead is rising.
Exactly. The overhead to maintain the golf course and the clubhouse is skyrocketing. And all those new members, they're just opting for the basic, $500 social tier instead of the premium $10,000 golf packages.
Ah, I see.
So the sheer volume of members walking around the dining room obscures the fact that the underlying profit margin is totally collapsing.
What's fascinating here is that captures the dynamic perfectly. Copeland diagnoses this as a maturing franchise facing real aggressive market competition.
Right.
They're having to work significantly harder, processing more entities, and managing way more administrative overhead just to maintain a diminishing revenue stream.
So the intrinsic premium value of a Delaware registration is diluting.
Yeah, they are basically accepting lower margins just to hold their market position.
But, if your core revenue engine is sputtering, the state still has to keep the lights on, right? The state police still need vehicles. The schools still need funding, which naturally brings us to the legislative response.
Right, the short-term fix to plug the gap.
Exactly. Let's introduce House Bill 400. This was signed into law quite recently on May 21st, 2026 by Governor Matt Meyer.
Sponsored by Representative Harris and Senator Townsend.
Yep. And what this bill basically did was raise the flat annual tax on LLCs, LPs, and general partnerships. It bumped the fee up from $300 to $400. And the report notes, this is actually the first increase on this specific tax since 2014.
Which brings up an interesting debate.
Right. And hold on, I got to stop you there and play devil's advocate for a second.
Go for it.
We are talking about raising a fee from $300 to $400, and it hasn't been touched in 12 years.
12 years, yeah.
If I'm Governor Meyer or Representative Harris, I am absolutely going to argue that a $100 increase over an entire decade barely even keeps pace with basic inflation. Why on earth is a report sounding the alarm over a routine inflationary adjustment? It seems like completely standard business practice to me.
And that is the exact defense the lawmakers used. And honestly, it is a logical defense in a vacuum. Representative Harris explicitly framed the bill around addressing a, quote, budget deficit.
Sure, you have a deficit, you raise a fee.
Right. And Senator Parody, who chairs the Joint Finance Committee, called the hike a responsible way to raise the revenue we need to balance our budget.
Which sounds totally reasonable.
They see a gap in the spreadsheet, and they are using a readily available lever to close it. It's a mechanical fix. But Copeland's critique, and this is really where his background as a former legislator colors the report, is that focusing on the $100 fee hike misses the forest for the trees.
Okay, how so?
The fee hike is just a symptom. Copeland argues the disease is unchecked, compounding spending.
So the problem isn't the $100 itself, it's the underlying structural reason they were forced to ask for the $100 in the first place.
Look at the trajectories mapped out in the data. The state has authorized its own spending to grow at over 5% a year.
Wow, okay.
But general fund revenue is only projected to grow by 4.1%, then 3.6%, and then drop to just 2.0%.
So you have compounding 5% spending growth colliding with shrinking 2% revenue growth.
Exactly. And in government finance, a 3% spread doesn't sound like much in year one, but it's the dark side of compound interest.
Yeah, that jaws of death chart just opens up wider every single year.
And the details within that revenue drop are even starker. Corporate income tax receipts, which, just to be clear, is a different bucket from the franchise tax. They are specifically projected to fall by 24% through fiscal year 2028.
24%?
Yeah. Corporate profits fluctuate, and if you rely heavily on that bucket, a 24% drop creates a massive crater in your general fund. The only bright spot keeping pace is personal income tax, which is growing at about 5%.
Which, I mean, makes the timing of House Bill 400 look incredibly convenient.
Oh, it is essentially identical to the shortfall. That $400 price increase aligns almost dollar for dollar with the $137.6 million that DEFAC suddenly added to its 2027 revenue forecast.
Wow. So without that price bump, the true gap between revenue and spending is massive.
Right.
Going back to the country club analogy, the board realizes their maintenance costs are totally out of control, but instead of, auditing their vendor contracts or cutting back on expenses, they just quietly tack a $100 surcharge onto everyone's monthly statement to cover the spread.
Perfect analogy. And the Caesar Rodney Institute actually warned about this back in September 2024. They pointed out that nearly all of Delaware's major revenue sources had already flatlined in chained dollars.
So this was totally predictable.
Yeah. The corporate franchise tax was the lone holdout still outpacing inflation back then. They warned it would inevitably stall, and now it has. So Copeland's core argument is that Delaware is leaning far too hard on its incorporation business to plug a self-inflicted spending gap.
But here is the danger of assuming your audience is completely captive. If you raise prices on your customers just to cover your own growing expenses, your own internal inefficiencies, you had better be absolutely certain your product is totally unique.
Right, because if they can get the same membership down the street for less, they will leave.
Exactly. And this is where the story shifts from a local state budget issue to a massive national economic battle. Here's where it gets really interesting. Delaware's century-old monopoly is officially under attack.
By Texas.
Yes, Texas. While Delaware is raising prices, Texas is aggressively building a direct alternative. And it's so ironic because Delaware is relied on just being the default home for businesses. But Texas has spent 20 years cultivating a fundamentally different and highly attractive environment.
Delaware relied on being the default setting, but Texas is actively building an alternative setting.
Let's anchor this to reality for the listener. If you are, say, a startup founder in Silicon Valley for the last 50 years, your lawyer just automatically incorporated you in Delaware. It was pure muscle memory. It was just what you did.
Right, you didn't even question it.
So what exactly is Texas offering that is breaking that muscle memory?
Well, first, let's look at human capital. Texas has zero personal income tax. None.
Zero.
To meet its budget needs, Texas just relies on a 6.25% sales tax. Copeland compares this directly to Delaware's top income tax rate of 6.99%.
Okay, so if I am that startup founder trying to poach top-tier engineering talent, geography is essentially compensation at that point.
Oh, absolutely.
If I tell a senior developer, hey, you get to keep roughly 7% more of your base salary just by living in Austin or Dallas instead of Wilmington, that is a massive, tangible recruiting advantage that goes way beyond just corporate registration fees.
It is a massive draw. And on the business side, Texas keeps taxes exceptionally low. The report notes that many small companies in Texas owe absolutely nothing in business taxes.
Nothing at all.
Nothing. Their philosophy isn't to heavily tax a fixed captive base of companies, which is essentially what Copeland argues House Bill 400 does in Delaware. Texas's philosophy is volume.
So they rely on a fast-growing private economy to naturally widen the tax base rather than taxing a fixed base more heavily.
Bring as many players into the casino as possible. Let the sheer volume of economic activity generate the sales tax and growth on the back end. High volume, low friction.
And it is clearly working. I mean, the verdict is in.
It is. Texas has been named the best state for business for nearly 20 consecutive years, and they lead the entire nation in corporate relocations.
But, relocating a physical headquarters or building a massive manufacturing plant is one thing. Delaware's bread and butter has always been the legal franchise, the paperwork.
Right.
That has always been the real unbreachable moat, right?
Right.
The court of chancery. We actually need to explain why that specific court matters so much to this whole dynamic.
We absolutely do, because the Court of Chancery is Delaware's real crown jewel. When most people think of a court, they picture a jury box, dramatic lawyers, unpredictable verdicts.
Like a TV show.
Right. But the Court of Chancery doesn't use juries. It is a court of equity, presided over by highly specialized corporate judges called chancellors. They deal strictly with complex corporate law mergers, acquisitions, shareholder disputes.
Right.
And because they have been doing this for so long, they have over a century of established, hyper-specific case law.
So if I am a CEO and a rival company tries a hostile takeover or, I don't know, an activist investor sues my board, I do not want to roll the dice with 12 random jurors who might not fully grasp complex financial derivatives.
Exactly. You want a chancellor who has ruled on 50 identical cases so your legal team knows exactly what your exposure is.
Predictability. Above all else, Delaware sold predictability. It was the ultimate barrier to entry. Other states couldn't just lower their tax rates to compete because they didn't have 100 years of chancery case law.
But if we connect this to the bigger picture, Texas is now crossing the Rubicon. They aren't just poaching physical offices anymore. They are actively cloning Delaware's unique selling points.
Wait, really?
Texas just officially opened a dedicated business court designed to directly rival the Court of Chancery.
They literally built a competing, specialized courthouse.
They did. And they didn't stop there. Backers have heavily funded a new Texas stock exchange to challenge the traditional strongholds. The infrastructure for a complete rival financial ecosystem is being laid down right now.
Wow.
And we're already seeing industry-defining companies validate it. The report points out that massive companies from Exxon to SpaceX to Dell, they've already moved their legal homes to Texas.
The SpaceX move is particularly fascinating to me. Obviously, Elon Musk has his own high-profile feuds with Delaware judges over his compensation packages. But moving a behemoth like SpaceX isn't just about a personal grievance.
No, it's way bigger than that.
It signals to the broader corporate world that the Texas legal framework is now considered robust enough to handle the governance of a multi-billion-dollar aerospace company.
It shatters the illusion that Delaware is the only safe harbor, and that is Copeland's core warning here. Trying to fix a compounding spending problem by repeatedly raising prices on your customers gets the economic diagnosis completely backward.
Right.
Delaware is actively sending its best customers to Texas, raising prices at the exact moment Texas is opening the new courthouse, launching the exchange, and perfecting the tax climate to welcome them.
It is a textbook case of a legacy monopoly failing to recognize that the barriers to entry in their industry have finally fallen.
Exactly. The moat has been bridged.
So what does this all mean? We have traced the arc today from a stalled revenue engine in Delaware that flatlined inflation-adjusted franchise tax to a short-term legislative fee hike in House Bill 400 meant to cover compounding state spending.
Yeah.
And then we zoomed out to see the direct existential threat from a deeply resourced competitor in Texas, aggressively open-sourcing Delaware's century-old secret sauce.
And this matters directly to you, the listener. Whether you are a first-time entrepreneur sitting at your kitchen table deciding where to file your new LLC paperwork, or if you are just a citizen watching how state governments balance their checkbooks and plan for the future.
Right. It affects everyone.
This report is a masterclass in what happens when a long-standing economic monopoly suddenly faces well-resourced, strategic market competition. You are watching real-time economic geography shift. The decisions made in state houses regarding a seemingly minor $100 fee increase or the funding of a new specialized court have massive cascading effects on where billions of dollars of capital choose to flow in this country.
It really is incredible to watch the macro effects of these micro decisions.
Yeah.
It leaves you with this one lingering question to mull over. If a state's primary export is essentially just paperwork, right? Predictability and a specialized legal framework. You don't have mountains or deep water ports or massive manufacturing hubs protecting your economy. Your moat is made of paper. And if another state with deeper pockets can simply build a rival courthouse and offer a cheaper tax code to your customers, what does the future hold for states that rely heavily on administrative monopolies rather than physical industries?
That is the big question.
The magical money tree is very real, but as Delaware is finding out, it can absolutely be transplanted. Thanks for joining us on this deep dive. Keep asking the big questions, and we'll catch you next time.